What if almost everything you've been taught about beating the stock market is working against you? The hot stocks, the superstar fund managers, the perfect time to buy. John Bogle spent decades proving that most investors don't need any of them. His strategy was almost embarrassingly simple. Stop searching for the winning stock and own the entire market. And the mathematics behind it could completely change the way you invest. There's a scene that plays out at a racetrack, and it captures something about investing so precisely that one of the most influential financial minds of the 20th century used it again and again to explain why an entire industry built around beating the stock market was for the overwhelming majority of people participating in it. Fundamentally a losing game. At a horse race, every dollar wagered goes into a pool before any of that money is redistributed to the winners. The track itself, the state, and various other parties take their cut first. What's sometimes called the croupier's take. Only what remains after that cut gets divided among the people who actually picked correctly. This means the betting public, taken as a whole, mathematically cannot win, on average, no matter how skilled any individual gambler might believe themselves to be. Some individuals win big, most lose, and the total amount lost by everyone who bet, summed together, always exceeds the total amount won, because the house always takes its cut first, before the money is ever divided up at all. The specific size of that croupier's take varies from track to track, but it's typically substantial enough, taken as a percentage of the total pool, that even a genuinely skilled handicapper correctly picking winners more often than pure chance would predict still struggles to overcome that built-in drag over a long enough stretch of consistent betting. The house doesn't need every individual bettor to lose. It simply needs its own guaranteed cut, taken automatically before any winnings are ever distributed, to ensure that the aggregate, taken across the entire betting population over time, reliably favors the house rather than the bettors as a whole. Bogle returned to this specific racetrack image repeatedly throughout his career in speeches, interviews, and various writings beyond this particular book, precisely because he found it captured something the more abstract, purely mathematical version of his argument sometimes struggled to convey with the same immediate intuitive force. Most people, he observed, intuitively understand why a casino or a racetrack, taking its guaranteed cut before any winnings are distributed, mathematically guarantees the house profits over time regardless of any individual gambler's skill. Getting that same intuitive audience to recognize the functionally identical mathematics operating within their own retirement account, disguised behind considerably more sophisticated, more professionally presented language required, in his experience, a bit more patient explanation. Precisely the explanation this entire book was written to provide. Now replace the racetrack with the stock market. Replace the croupier's take with something considerably less visible but functionally identical: the fees, commissions, and expenses charged by the entire financial industry. The fund managers, the brokers, the advisors, all of them taking a cut before any of the market's actual returns ever reach an ordinary investor's own pocket. The man who spent decades making this exact comparison relentlessly, sometimes to the genuine irritation of an entire industry, built around convincing people otherwise, was John Bogle, the founder of Vanguard and the creator of the first index fund ever made available to ordinary individual investors. Bogle's own path toward this conviction began decades earlier. As an undergraduate writing a senior thesis on the mutual fund industry, a piece of student research that even at that early stage noted with some skepticism that mutual funds taken as a group appeared to offer no particular advantage over the broader market they were supposedly trying to beat. That early, almost accidental observation would go on to shape the entire trajectory of his career eventually leading him decades later to found an investment company built specifically around the opposite of everything the rest of the industry seemed to be selling. He describes the specific research process behind that original thesis in some detail, recounting hours spent poring over industry data as a student long before that data was easily accessible, the way modern financial databases eventually made it, painstakingly gathering and comparing fund performance figures against broader market benchmarks by hand. He treats this early laborious research process as formative in a way that went beyond simply the specific conclusion it produced, instilling in him a lifelong habit of insisting on genuine, rigorously verified data, rather than simply accepting the financial industry's own confident claims about its own performance at face value, a habit that would define his entire subsequent career of research and public advocacy. He describes an early mentor's advice from around that same period, encouraging him to keep asking sharp, uncomfortable questions of an industry that generally preferred not being asked them. Advice he credits with helping shape the specific, persistent, evidence-demanding temperament that would eventually carry him through decades of skepticism and resistance from an industry with every financial incentive to keep those exact questions from ever being asked too loudly or too often. He spent years working his way up through the traditional fund management industry, eventually reaching the top of a major mutual fund company before a corporate merger dispute led to his own ouster from the firm he'd helped build, rather than treating this professional setback as an ending. Bogle used it as the specific occasion to found an entirely new company, one built from the ground up around the philosophy his own early research had first pointed him toward decades earlier, a company that would eventually become Vanguard. Bogle's own personal story carries an additional dimension worth mentioning, since it shaped the specific urgency and clarity with which he wrote throughout his career. He lived for decades with a serious heart condition, eventually receiving a heart transplant later in life. An experience he wrote about candidly in various places, describing how it sharpened his own sense of purpose and his own determination to keep advocating for ordinary investors for as long as he possibly could. He often connected this personal experience with mortality directly to his broader philosophy about patience and long-term thinking, arguing that just as his own life had been extended through genuine hard-won medical progress rather than any quick fix or shortcut, genuine long-term wealth was similarly built through patient, disciplined progress rather than any exciting shortcut promising instant results. He described feeling a particular renewed sense of urgency in the years following that transplant, aware in a deeply personal way that his own remaining time was genuinely limited and channeling that awareness into continuing his public advocacy work with, if anything, even greater energy and directness than before, right up through his final years. Colleagues who worked alongside him during this later period described him as remarkably undiminished in his enthusiasm for the cause he'd spent his entire career championing, still personally responding to letters from ordinary investors, still delivering speeches and writing new material, still relentlessly repeating the same core arithmetic he'd first begun arguing decades earlier, evidently convinced to the very end that the message remained worth repeating for however many new investors had yet to actually hear and understand it. His book, The Little Book of Common Sense Investing, distills an entire career's worth of research and argument into a single devastatingly simple message. Trying to beat the stock market through active stock-picking, market timing, or paying someone else to do either on your behalf is, for the overwhelming majority of investors, a losing proposition, not because the market is unbeatable in theory, but because the costs involved in trying to beat it reliably exceed whatever advantage skilled selection might otherwise provide. Stick with this one, because Bogle's argument isn't simply an opinion. It's built on a piece of arithmetic, so basic, so genuinely undeniable once you actually sit with it, that he called it the relentless rules of humble arithmetic, and once you understand it clearly, an enormous amount of what the financial industry spends billions of dollars every year trying to sell you starts to look considerably less compelling. And if you enjoy discovering the most powerful lessons from the world's best books on money, investing, and wealth, subscribe to Money Files audiobooks. We turn timeless financial books into deep practical stories you can actually use. Now, let's look at the simple arithmetic that changed investing forever. Here's that arithmetic, laid out as simply as Bogle himself insisted on laying it out. If you're keeping track of the overall shape of Bogle's entire argument so far, it's worth naming the pattern directly, because it's a pattern that keeps reappearing from a dozen different angles throughout the entire rest of the book. Every single specific cost Bogle examines, management fees, trading costs, taxes generated by unnecessary turnover, the behavior gap created by poorly timed investor decisions, all point toward the exact same underlying conclusion. Whatever the specific mechanism, the direction of the effect is always the same: costs subtracted from a fixed, shared pool of market returns, mechanically reducing what's actually left over for the investors paying those costs, regardless of how sophisticated, well-marketed, or confidently presented the specific product charging those costs happens to be. The total return generated by the entire stock market in any given year is a fixed specific number, the sum of every dividend paid and every dollar of capital appreciation across every publicly traded company combined. Every single investor participating in that market collectively earns a share of that same total return before any costs are subtracted, but costs are subtracted. And here's the part Bogle spent his entire career hammering home. Because every investor collectively owns the entire market, the average investor before costs must earn exactly the market's average return, no more, no less. This isn't a theory or an opinion or a debatable prediction. It's simple arithmetic. If you add up everyone's individual returns, weighted by how much money each person has invested, that sum must equal the market's total return, because collectively all investors together are the market. Bogle illustrates this with a simple, concrete thought experiment worth holding on to. Imagine every single share of every publicly traded company in existence, owned collectively by every investor currently participating in the market, whether directly through individual stock ownership or indirectly through a mutual fund. Before any costs are subtracted, the total return earned by this entire collective group of owners must, by definition, equal the market's own total return, since that collective group, taken together, owns literally everything the market consists of. There's no mathematical way for the average owner within that collective group to earn more than the market itself generates, since the group's combined holdings are the market. He extends this thought experiment slightly further, addressing a common intuitive objection readers sometimes raise, that surely a sufficiently skilled subset of investors could somehow extract more than their proportional share of the total pool, leaving less for everyone else without the overall arithmetic actually breaking. Bogle agrees this is exactly right and precisely his point. Some investors absolutely can and do extract more than their proportional share, precisely by taking it from other investors within that same collective pool, since the total pool available to be divided remains fixed, regardless of how skillfully any individual participant maneuvers within it. This is exactly why he describes the pre-cost version of investing as a zero-sum game, one person's above-average return necessarily coming at the expense of another person's below-average return. with the pool of total returns itself neither growing nor shrinking based on how it happens to be divided up among the various participants. Once you subtract the cost, fund management fees, trading commissions, taxes generated by excessive trading, the average investor's net return necessarily falls below the market's actual return by exactly the amount those costs consume. This isn't something that happens to unlucky or unskilled investors. It's a mathematical certainty that applies to the average investor as a group, regardless of skill. This means that beating the market, for any individual investor or fund manager, requires taking returns away from some other investor or fund manager, since the total pool of returns available to be divided among all investors before costs is fixed. Bogle describes this as a zero-sum game before costs and a loser's game after costs, since the costs themselves guarantee that the average participant across the entire investing population must underperform the market they're all trying to beat. Active fund managers employing teams of analysts, conducting extensive research trading frequently in pursuit of superior stock selection, charge considerably higher fees than a simple passively managed index fund, which merely holds every stock in a given market index in proportion to its size, without attempting to select winners or avoid losers at all. Bogle's argument is that this higher fee, charged by active management, isn't simply an unfortunate cost that active investors pay in exchange for a legitimate chance at superior returns. It's a cost that mathematically guarantees active management as a whole must underperform a low-cost index fund as a whole, precisely because active managers are all drawing from that same fixed pool of market returns while paying considerably more in fees along the way. He addresses a specific, related question worth clarifying directly. Who exactly is on the other side of this zero-sum competition, since active management as an entire category clearly can't be trading purely against itself, without some other participant absorbing the corresponding loss? Bogle's answer points partly toward the relatively small remaining population of individual amateur investors still trading actively on their own behalf, and partly toward the simple mathematical drag that costs themselves impose on the entire actively managed category collectively. Meaning active managers taken together are effectively also competing against the very fee structure. Their own industry has built a competition that mathematics guarantees they must collectively lose regardless of how skillfully any individual manager might otherwise perform in isolation. He walks through decades of actual historical data supporting this argument, showing that the overwhelming majority of actively managed mutual funds examined over long stretches of time have failed to outperform a simple low-cost index fund tracking the broader market. After accounting for the fees those active funds charge, the specific percentage varies somewhat depending on which exact period is examined, but the underlying pattern across every stretch of market history Bogle studied remains remarkably consistent. A clear majority of actively managed funds underperforming their relevant benchmark index over any sufficiently long time horizon. He's careful to note that this pattern actually strengthens rather than weakens the longer the time horizon examined. Over a single year, a meaningful minority of active funds might outperform their benchmark, simply through ordinary statistical variation across a large population of managers. Over a full decade, that minority shrinks considerably. Over 2 or 3 decades, the number of funds that have both survived the entire period and genuinely outperformed their benchmark net of fees becomes strikingly small, a pattern Bogle considers powerful evidence that whatever short-term outperformance individual managers occasionally demonstrate rarely reflects a durable, repeatable skill capable of overcoming the fee drag over any sufficiently long stretch of real time. he addresses a specific related research question worth understanding directly: whether the specific funds that outperformed during one particular decade tended to be the same funds outperforming during the following decade, a test of genuine persistent skill rather than simply one-off non-repeating luck. Bogle's own research and the broader body of academic literature he draws on throughout the book finds remarkably weak persistence of this kind, funds outperforming in one period, showing little reliable tendency to continue outperforming in the next, a pattern considerably more consistent with random variation across a large population of managers than with any genuine, identifiable, repeatable skill separating the temporary winners from the temporary losers. He offers a specific illustration of this weak persistence, describing research that sorted actively managed funds into groups based on their performance during one specific period, then tracked how each group actually performed during the subsequent period. Rather than the top-performing group reliably remaining the top-performing group, as genuine persistent skill would predict the actual results, showed considerably more scrambling funds from the middle or even bottom of the original ranking, frequently rising toward the top in the subsequent period, and vice versa, a pattern of shuffling considerably more consistent with statistical noise than with any durable, identifiable managerial skill. Bogle devotes considerable attention to a specific related phenomenon that helps explain why active management's poor track record isn't simply bad luck, something called reversion to the mean. A fund manager who happens to post spectacular returns over a given 3 or 5 year stretch attracts enormous media attention and enormous new investment from eager investors hoping to ride that same hot streak. But Bogle's research shows that this kind of outperformance, examined over subsequent years, tends not to persist reliably. The manager celebrated as a genius during one stretch frequently reverts toward or even below the broader market average during the following stretch, a pattern consistent with genuine skill being considerably rarer than pure statistical luck across a large population of professional fund managers all competing simultaneously. He offers a specific illustrative account of this pattern playing out repeatedly across decades of fund industry history, describing funds that topped the annual performance rankings, appeared on magazine covers celebrating their managers' apparent brilliance, attracted enormous new investment inflows from excited investors, and then within just a few subsequent years fell back to middling or even below average performance, leaving the very investors who'd piled in near the top holding a fund now underperforming the broader market they could have simply owned directly at a fraction of the cost. Bogle treats this recurring pattern not as an unfortunate coincidence, but as the predictable, mathematically expected consequence of survivorship and statistical variation operating across a large population of managers, the overwhelming majority of whom he argues possess no genuine durable edge over the market at all. He describes a specific mechanism worth understanding directly that helps explain why this reversion pattern tends to occur so reliably, related to what happens to a fund's own strategy once it attracts a large influx of new money following a celebrated hot streak. A fund manager whose strategy worked well while overseeing a relatively modest amount of capital often finds that same strategy considerably harder to execute effectively once a flood of new investor money arrives, since larger trades tend to move prices more noticeably, and since certain strategies that work well at a smaller scale simply don't scale up proportionally without losing some of their original effectiveness. Bogle considers this specific dynamic, sometimes called the curse of asset growth, a genuine structural contributor to the reversion pattern, distinct from pure statistical luck. One more reason a fund's celebrated recent past performance offers a poor guide to its likely future performance, particularly once that celebrated performance has already attracted a substantial wave of new investor capital. This creates a particularly costly trap for ordinary investors who chase recent performance, a trap Bogle describes in some detail. An investor who moves their money into whichever fund happens to have posted the best returns over the past few years is, in effect, buying in right around the peak of that fund's temporary hot streak, precisely the moment statistical reversion becomes most likely to kick in and drag that fund's future performance back down toward or below the broader market average. Bogle's research shows that the actual returns experienced by ordinary mutual fund investors accounting for this exact pattern of chasing recent performance tend to run considerably below even the already underwhelming average returns of the funds themselves. Since investors so frequently pile in near a fund's peak and pull out near its trough, he puts a specific number on this gap in several places throughout the book, describing what he calls the behavior gap, the measurable difference between a fund's own reported average annual return over a given period and the considerably lower average return actually experienced by the fund's own investors. Once their specific pattern of buying near peaks and selling near troughs is properly weighted into the calculation. This behavior gap, Bogle argues, represents an entirely separate additional cost layered on top of the fee and tax disadvantages already working against active management, one driven purely by predictable, all-too-human psychological patterns rather than by the fund's own underlying investment strategies at all. He illustrates the sheer scale of this behavior gap with a specific example worth remembering directly. A given actively managed fund might report a genuinely respectable average annual return of, say, 10% over a particular decade, a figure that sounds perfectly attractive when reported in isolation. But when Bogle's research actually weights that same fund's returns by the specific dollar amounts flowing in and out of the fund at different points during that decade, accounting for the fact that considerably more money tended to flow in near the fund's temporary peaks and considerably more money tended to flow out near its temporary troughs, the actual dollar-weighted average return experienced by the fund's real investors often comes in several percentage points lower than that same headline figure, a gap purely attributable to poorly timed investor behavior rather than to the fund's own underlying investment performance. He treats this behavior gap as powerful additional evidence supporting the simplicity of index investing, arguing that a broad, low-cost index fund, precisely because it doesn't generate the same kind of exciting headline-grabbing hot streaks that tempt investors into poorly timed chasing behavior, tends to produce a considerably smaller behavior gap between its reported returns and its investors' actual dollar-weighted experienced returns, since there's simply less exciting short-term performance data to chase in the first place. He extends this observation into a broader closing reflection on the entire relationship between simplicity and genuine investor success, arguing that an unglamorous, unexciting investment strategy carries a subtle, underappreciated behavioral advantage entirely separate from its lower costs alone. Precisely because index investing generates so little exciting headline-worthy news, to react to it naturally encourages the kind of calm, disciplined patience that active investing's constant stream of exciting performance data actively works against. A quiet, psychological benefit Bogle considered every bit as valuable over a genuine investing lifetime as the more easily quantified cost savings he spent the rest of the book so carefully documenting. Bogle also addresses the specific, seductive appeal of survivorship bias, a statistical distortion that makes active management's track record look considerably better than it genuinely is when examined carelessly. When a mutual fund performs poorly for long enough, it frequently gets quietly shut down or merged into a better performing fund within the same larger fund family, and its poor historical track record simply disappears from most standard performance databases. What remains? When someone casually examines the average actively managed fund's historical performance, is disproportionately made up of the funds that happen to survive long enough to still be around, flattering the industry's aggregate numbers considerably more than an honest, complete accounting would actually support. He illustrates the sheer scale of this distortion with specific figures drawn from his own research, describing what percentage of actively managed funds launched at the start of a given multi-decade period were still operating under their original name and strategy by the end of that same period. The number in Bogle's telling is considerably smaller than most casual observers assume, meaning that a great many of the funds an investor might have chosen from at the beginning of their investing journey simply won't exist anymore by the time that journey concludes decades later. Having been quietly folded away after years of disappointing performance, their track record scrubbed from the headline statistics most casual comparisons rely on. He offers a specific illustration worth remembering, describing a hypothetical group of 100 actively managed funds, all launched around the same time, tracked forward across several subsequent decades. By the end of that stretch, Bogle's research suggests a substantial portion of that original 100 will have disappeared entirely, merged quietly into better performing siblings within the same fund family, or shut down outright, leaving only a minority of the original group still operating under recognizable names, and leaving an even smaller minority that both survived the entire period and genuinely outperformed their relevant benchmark net of all fees along the way. An investor examining only the survivors, without properly accounting for the considerably larger group that quietly disappeared along the way, would form a badly distorted, overly optimistic picture of active management's genuine historical track record. He connects this specific distortion directly back to the ordinary investor's practical experience, warning that anyone comparing the average mutual fund's performance against a benchmark index using data that fails to properly account for this survivorship effect will consistently and systematically overstate how well active management has actually performed, precisely because the worst performing funds have already been quietly removed from the comparison before it was ever run. Beyond the direct fees charged by active fund managers, Bogle spends real time on a second, less visible cost that compounds the first: the tax consequences of frequent trading. An actively managed fund buying and selling individual stocks, constantly in pursuit of superior selection, generates considerably more taxable capital gains for its shareholders than a passively managed index fund which simply holds its underlying stocks for years or decades, at a time rarely triggering a taxable event at all. Bogle calls this combination of higher fees and higher taxes the double whammy, a compounding drag on an active investor's net after-tax returns that makes the mathematical case against active management even more overwhelming than the fee comparison alone would already suggest. He walks through the specific mechanics of why this tax difference matters so much more than most investors initially realize. Every time an actively managed fund sells a stock at a profit, that realized gain typically gets distributed to the fund's shareholders, who then owe taxes on it that particular year, regardless of whether they personally sold any of their own shares in the fund at all. An index fund, by contrast, rarely needs to sell its underlying holdings at all, since it simply maintains its position in every company within its target index, meaning its shareholders accumulate unrealized gains that go untaxed for as long as they continue holding the fund, sometimes for decades, deferring that tax obligation considerably further into the future than an actively traded fund's shareholders ever could. He describes a specific practical detail worth understanding clearly: the difference between short-term and long-term capital gains, taxation, and how an actively managed fund's frequent trading tends to generate a disproportionate share of the less favorably taxed short-term variety compared to an index fund's own considerably more patient long-term holding pattern. A stock held for less than a year before being sold typically generates a short-term capital gain, taxed at a meaningfully higher rate than a long-term gain earned on a position held for longer. An actively managed fund's frequent buying and selling, Bogle notes, tends to generate considerably more of these less favorably taxed short-term gains than a passive index fund's own naturally patient low-turnover approach, compounding yet another specific disadvantage onto the already substantial tax gap between the two approaches. He offers a specific illustration of just how dramatically this double whammy compounds over an entire investing lifetime. Two investors, each starting with an identical sum, each earning the exact same underlying gross market return before costs over a full multi-decade investing career. One invests in a low-cost, broadly diversified index fund, minimizing both management fees and unnecessary taxable trading. The other invests in a typical actively managed fund, paying considerably higher fees and generating considerably more taxable trading activity along the way. By the end of that multi-decade period, the gap between the two final balances, driven purely by this compounding difference in costs and taxes, can easily consume a third or more of what the actively managed investor's final nest egg otherwise could have been. Despite both investors experiencing the exact same underlying market performance the entire time, Bogle describes watching this specific tax disadvantage catch even sophisticated, well-informed investors genuinely off guard, since the actual tax bill generated by an actively managed fund's frequent trading often arrives as an unwelcome surprise each year, buried within routine year-end tax paperwork rather than presented clearly up front alongside the fund's more visible management fee. He considers this relative invisibility part of why the tax cost of active management has historically received considerably less attention from ordinary investors than the more obvious, clearly disclosed management fee, despite frequently representing an equally significant, sometimes even larger, drag on an investor's genuine after-tax return. Bogle offers a specific concrete comparison of typical fee levels worth carrying forward, contrasting the expense ratios commonly charged by actively managed equity funds during the era he was writing against the considerably lower expense ratios charged by broadly diversified index funds tracking the same underlying market. The gap, expressed as a simple percentage difference, might sound modest at first glance, often somewhere in the range of 1 percentage point or so annually. But Bogle insists on walking readers through exactly what that seemingly modest annual gap actually compounds into across an entire multi-decade investing career. Precisely the kind of compounding arithmetic that makes a seemingly small percentage difference into a genuinely enormous difference in final dollar outcomes by the time an investor actually reaches retirement. Let's walk through that arithmetic directly, since seeing the specific numbers laid out tends to make the abstract percentage considerably more concrete. Picture two investors, each contributing an identical sum every year to their respective retirement accounts over a full 50-year working and investing lifetime, each earning the exact same underlying gross market return before costs. One investor pays an annual expense ratio of roughly 0.2%, typical of a low-cost broad index fund. The other pays an annual expense ratio closer to 1.25%, roughly typical of a conventional actively managed equity fund. By the end of that 50-year period, Bogle calculates the low-cost investor ends up with a final balance considerably larger, often by well over a third, purely as a consequence of that seemingly modest annual fee difference compounding quietly, year after year, decade after decade, entirely independent of which specific stocks either fund actually happen to hold along the way. He describes presenting this exact calculation to countless audiences over the decades and describes the specific reaction it reliably produced: genuine surprise, sometimes even visible discomfort, among listeners who had never actually seen the abstract percentage translated into real dollar terms before. He considered this specific demonstration repeated countless times throughout his career one of the single most persuasive tools available for actually shifting how ordinary people thought about investment costs, since an abstract percentage difference rarely registers with the same emotional weight as watching a concrete dollar-denominated gap accumulate visibly across an entire lifetime of saving. He extends this same demonstration to a related, equally sobering way of framing the identical underlying calculation, describing what percentage of an investor's total final accumulated wealth, after a full multi-decade career of saving and investing, actually ends up transferred to the fund management industry itself in the form of accumulated fees paid along the way, compared to what percentage remains genuinely available for the investor's own retirement. Bogle calculates that for a sufficiently long investing career, paying the kind of elevated fees typical of conventional actively managed funds that cumulative transfer to the industry can easily consume well over a third of an investor's total potential final wealth. A framing he found particularly effective at capturing audiences' genuine attention, since it reframes the abstract fee percentage as a direct, tangible claim on the investor's own eventual retirement security. He offers a related observation about how these fee levels have shifted over the decades since he first began making this argument, noting that the sheer weight of his own accumulating evidence, combined with the steadily growing popularity of low-cost index investing itself, has gradually pushed average fees across the broader fund industry downward, over time a trend he considers among the most gratifying tangible results of his own decades of research and advocacy. Even as he continued arguing that fees across much of the actively managed fund industry still remained considerably higher than they reasonably needed to be, Bogle also addresses a specific related cost category that extends beyond a fund's simply stated expense ratio. Sometimes called trading costs or transaction costs, the ordinary expenses a fund incurs every time it actually buys or sells a stock, commissions, bid-ask spreads, and the subtle price impact that occurs when a large fund's own trading activity moves a stock's price against itself. These costs, he notes, don't typically appear anywhere within a fund's stated expense ratio at all, since they're embedded directly within the fund's reported investment returns rather than disclosed as a separate explicit fee line item, making them considerably harder for an ordinary investor to identify and compare across different funds, despite representing a genuine, measurable additional drag on net returns. He points out that this specific hidden cost category tends to run considerably higher for actively managed funds than for passively managed index funds, precisely because active funds trade their underlying holdings far more frequently in pursuit of superior stock selection, generating considerably more of these hidden transaction costs along the way, compounding yet another layer onto the already substantial gap between active and passive investing's respective net returns, beyond even the explicit expense ratio and tax disadvantages already discussed at length throughout the rest of the book. He offers a specific illustration of just how significant these embedded trading costs can become for a genuinely active fund. Describing research estimating that a fund turning over its entire portfolio multiple times within a single year, a genuinely common pattern among more aggressively traded active strategies, can incur trading costs alone, embedded invisibly within its reported returns, that rival or even exceed its own explicitly stated expense ratio. This means the true total cost gap between a genuinely active high-turnover fund and a low-turnover index fund can run considerably wider than a simple comparison of their respective published expense ratios alone would ever suggest. A further sobering layer to the already substantial cost case Bogle builds throughout the entire book. He notes that this specific gap between headline expense ratios and true all-in costs represents precisely the kind of information asymmetry that makes the entire fund industry considerably harder for an ordinary, well-intentioned investor to navigate confidently, without deliberately seeking out the fuller picture. A further reason he considers genuine investor education of exactly the kind this entire book was written to provide, so essential to leveling what would otherwise remain a persistently uneven playing field between the industry selling these products and the ordinary people buying them. He offers a specific way of estimating the rough scale of this hidden cost category, describing research attempting to quantify the typical annual drag imposed by trading costs alone across a broad sample of actively managed funds, a figure that, while inherently harder to measure precisely than a fund's clearly stated expense ratio, nonetheless appears to add a further meaningful fraction of a percentage point to the overall cost gap separating active management from a comparable low-cost index fund. He treats this additional largely invisible cost layer as one more reason the true all-in gap between active and passive investing tends to run even wider than a simple comparison of stated expense ratios alone would suggest, since a great deal of the actual cost differential simply never appears as an explicit disclosed line item at all. Bogle's proposed solution, laid out across the rest of the book, is disarmingly simple, and it's precisely the solution he spent his entire career building an entire company around delivering to ordinary people, rather than attempting to select the specific stocks or the specific actively managed fund that will outperform the broader market. An investor should simply own the entire market through a broadly diversified low-cost index fund, capturing the market's full return, minus only the smallest possible sliver of cost required to actually operate the fund itself. Bogle gives this entire underlying principle a specific formal name throughout the book, calling it the cost matters hypothesis, a deliberate play on a more famous piece of academic finance theory called the efficient market hypothesis, where the efficient market hypothesis debates whether markets accurately reflect all available information at any given moment, a genuinely contested and debated question among academics. Bogle argues the cost matters hypothesis requires no such debate at all. Whether or not markets are perfectly efficient, the simple, undebatable fact that lower costs mechanically translate into higher net returns for investors holds true regardless, a mathematical certainty rather than a contested theory. He describes finding a certain wry satisfaction in this specific naming choice, noting that decades of academic debate over whether markets were genuinely perfectly efficient had generated an enormous body of research, countless conference papers, countless dissertations, while his own considerably simpler cost matters hypothesis, requiring no sophisticated academic modeling at all, simply basic arithmetic anyone could verify for themselves, had proven at least as reliable a guide to actual investor outcomes, arguably more so, throughout his own decades of practical observation. He considered this contrast between an elaborate, heavily debated academic theory and his own considerably simpler, empirically verifiable observation, a useful reminder that genuinely important investment truths don't always require sophisticated theoretical justification. Sometimes, he argued, they simply require the discipline to actually look honestly at the numbers. He extends this same cost matters hypothesis beyond stock investing alone, applying it with equal force to bond investing, an area he considers, if anything, even more clearly favorable to a low-cost, indexed approach than stock investing, since bonds themselves offer considerably less room for genuine skill-based outperformance in the first place, given their more predictable contractually defined cash flows. A bond fund charging meaningfully higher fees than a comparable low-cost bond index fund, Bogle argues, faces an even steeper uphill mathematical battle than an actively managed stock fund does, since the total potential universe of returns available to be fought over is itself considerably narrower and more predictable within the bond market. He walks through the specific reasoning behind why bonds offer even less room for genuine active management skill compared to stocks, pointing out that a bond's total return is largely determined by its stated interest rate and its price at maturity, both of which are contractually specified in advance, leaving considerably less room for a skilled analyst's insight to meaningfully improve upon simply owning a broad, diversified basket of bonds matching the overall market. Stocks, by contrast, involve considerably more genuine uncertainty about a company's future earnings and competitive position, theoretically leaving somewhat more room in principle for genuine analytical skill to add value. Even though Bogle's own research suggests that even this theoretically larger opportunity rarely translates into genuine, reliable outperformance once costs are properly accounted for. He famously summarized this entire philosophy in a single memorable phrase: "Don't look for the needle in the haystack. Simply buy the haystack," rather than spending enormous time, effort, and money trying to identify which individual stocks or which individual fund managers will happen to outperform in the coming years. An investor following this approach simply owns every stock in the entire market, simultaneously guaranteeing they'll capture whatever return the market as a whole actually generates without ever having to correctly guess which specific needles among thousands of possibilities will turn out to be the winners. He extends this specific metaphor a bit further, pointing out that even a genuinely skilled investor capable of correctly identifying a handful of future winning stocks still faces the considerable challenge of correctly avoiding the far larger number of stocks that will underperform or fail entirely, and of correctly sizing each individual position appropriately relative to that investor's own overall portfolio. Missing even a small handful of a market's biggest long-term winners, having sold too early or never having identified them in the first place, can meaningfully drag down an otherwise carefully constructed portfolio's overall long-term return. Since a disproportionate share of the broader market's total long-term gains examined over sufficiently long stretches of history tends to come from a relatively small number of exceptionally strong performers. Owning the entire haystack guarantees an investor captures every one of those rare, outsized winners automatically, entirely sidestepping the difficult, high-stakes challenge of correctly identifying them in advance. He cites research on this exact pattern, describing studies examining what percentage of a broad market index's entire long-term cumulative return over many decades could actually be traced back to a relatively small handful of exceptionally successful individual companies, with the vast majority of the remaining companies contributing comparatively little to the market's overall long-term gain or even losing value entirely over the same period. This finding, Bogle argues, dramatically raises the stakes of missing even one or two of these rare, exceptional winners through an active selective stock picking approach, since the cost of that single miss can meaningfully exceed the benefit of correctly avoiding several genuinely poor performers elsewhere in the same portfolio. Bogle describes the specific considerable resistance this idea faced when he first launched it as an actual available product in 1976, an index fund available to ordinary retail investors for the first time in the industry's history. The financial press mocked it openly, some critics calling it un-American, as though deliberately choosing to match the market's average return rather than chasing the fantasy of beating it, represented some kind of embarrassing surrender rather than a mathematically sound decision. Competing fund companies distributed posters ridiculing the concept, confident it would fail to attract meaningful investor interest. The launch itself, by most honest measures, came remarkably close to failing outright. Bogle had hoped to raise a considerable sum for this first index fund's initial offering. It actually raised only a small fraction of that original target, barely enough by some accounts to justify the fund's continued existence at all in the eyes of skeptical observers within the industry. He describes the specific atmosphere surrounding that difficult launch period, candidly recalling rival firms, confidently predicting the entire concept would quietly fold within a few years, and recalling his own considerable uncertainty during those early months about whether the fund would even survive long enough to prove its underlying thesis correct at all. Underwriters involved in the original offering reportedly grew visibly nervous as the fundraising total came in far below projections, and some within Bogle's own young company privately wondered whether the entire venture had been a serious miscalculation. It didn't fail. It grew, slowly at first, then with steadily increasing momentum, as the underlying mathematics Bogle had laid out kept proving itself correct, year after year, decade after decade, in real market data that grew increasingly difficult for even the most committed skeptics to dismiss today. Index investing built directly on the foundation Bogle laid with that first nearly failed fund manages many trillions of dollars worldwide, and the specific approach he championed, once dismissed as heretical, has become one of the single most influential developments in the entire history of personal investing. He describes watching, with a certain quiet satisfaction, the same competing fund company who had once openly mocked the entire concept eventually launch their own index fund offerings, sometimes decades later, effectively conceding the very argument they'd once ridiculed so confidently. He treats this eventual grudging industry-wide acceptance as the ultimate vindication of his original thesis, evidence that the relentless rules of humble arithmetic, however unwelcome to an industry built around convincing investors otherwise, simply couldn't be argued away indefinitely once the accumulated decades of real, verifiable market data made the underlying pattern impossible to keep disputing credibly. He offers a specific, reflective passage on what this entire journey, from ridiculed outsider to widely vindicated pioneer, actually taught him about the nature of genuine, durable change within any established industry. Real change, he argued, rarely comes from persuasive argument alone, however logically sound that argument might be. It comes from patiently, stubbornly, continuing to demonstrate the argument's validity through real accumulating evidence, year after year, decade after decade, until the sheer weight of that evidence simply becomes too large for even the most entrenched, most financially motivated skeptics to keep dismissing credibly. He draws a broader, more personal lesson from this specific journey, one he returns to repeatedly throughout the book's later chapters, suggesting that the same patience and stubborn persistence required to build his own company against decades of industry skepticism mirrors almost exactly the same patience and stubborn persistence an ordinary individual investor needs to actually stick with a simple, low-cost index strategy through years of tempting, more exciting-sounding alternatives constantly being marketed as superior. Both in his telling require the same underlying discipline, trusting the relentless, unglamorous arithmetic over the considerably more exciting, more persuasive-sounding story, and simply waiting patiently for that arithmetic to eventually prove itself correct, as it reliably has across every sufficiently long stretch of market history he ever managed to examine. Bogle built Vanguard itself around a genuinely unusual corporate structure specifically designed to reinforce this entire philosophy, one worth understanding directly, because it explains why the company was able to offer such remarkably low costs compared to its competitors in the first place. Rather than being owned by outside shareholders seeking to maximize the company's own profit, Vanguard is structured so that it's effectively owned by the mutual funds it manages, which are in turn owned by the ordinary individual investors holding shares in those funds. This meant Vanguard had no outside owners demanding ever higher profits extracted from fund shareholders, allowing the company to operate, deliberately, at close to cost, passing along the resulting savings directly to the same ordinary investors the funds were actually serving. He describes the specific reasoning behind choosing this unusual structure quite deliberately, rather than simply following the conventional model used by nearly every other fund company in the industry, where the management company itself is a separate, for-profit entity owned by outside shareholders or private owners with every incentive to maximize its own profit, often at the direct expense of the fees charged to the fund's own ordinary investors. Bogle considered this conventional structure a fundamental built-in conflict of interest, one where the company managing your money and the company profiting from your money were in effect working against your own best interests by design, regardless of how well-intentioned any individual employee within that company might personally be. He recounts the specific, somewhat unusual regulatory approval process required to establish this mutual ownership structure in the first place, describing negotiations with regulators who had never previously encountered a fund company structured quite this way, and describing his own persistent efforts to convince skeptical officials that this genuinely unusual arrangement served investors' interests more faithfully than the conventional model everyone else in the industry had simply taken for granted as the only viable way to organize a fund company. He treats this early regulatory struggle as an important, if less well-known part of the broader story, evidence that even the basic structural foundation of his entire company faced genuine resistance before it was ever allowed to actually operate as originally envisioned. He reflects on this early struggle as, in hindsight, a fitting preview of nearly everything that followed throughout the rest of his career, a pattern of proposing something genuinely aligned with ordinary investors' own best interests, facing skepticism and resistance from an established system built around a different set of assumptions, and ultimately persisting long enough for that genuinely investor-aligned idea to eventually prove itself correct, one accumulating year of real evidence at a time. He describes arriving at this specific structural insight relatively early in his career, well before he'd fully developed the index fund concept itself, recognizing that even a genuinely well-run, honestly managed conventional fund company still faced a persistent, structural temptation to gradually raise fees over time, simply because doing so directly benefited that company's own outside owners, a temptation entirely absent within Vanguard's own mutual ownership structure, where the fund company's only genuine owners were the very same ordinary investors those higher fees would otherwise come out of, He considered eliminating this specific structural temptation rather than simply hoping individual executives would consistently resist it out of pure goodwill. Considerably more reliable and considerably more durable over the long run, precisely the kind of structural rather than purely personal solution he favored throughout his career. Bogle considered this structural choice every bit as important to his overall mission as the index fund concept itself. Since a low-cost investment product offered by a company still structurally incentivized to maximize its own profit at shareholders' expense would, over time, tend to see those cost advantages gradually eroded. Precisely the opposite of what a genuinely investor-first structure was specifically designed to prevent. He points to the actual measurable track record of Vanguard's fees over the following decades as evidence that this structural choice genuinely mattered in practice, not merely in theory. Describing how the company's average expense ratios continued declining steadily over time, even as the company itself grew into one of the largest asset managers in the entire world, a pattern he considers difficult to imagine unfolding the same way under a conventional profit-maximizing corporate structure where growing scale more typically translates into growing profits for outside owners rather than continually falling costs passed along to the fund's own underlying investors. He offers a specific illustrative comparison worth remembering. Contrasting the typical expense ratio charged by Vanguard's own broad market index funds against the considerably higher expense ratios typically charged by comparable actively managed funds offered by conventionally structured profit-seeking fund companies. The gap, he argues, isn't simply a reflection of Vanguard being more efficient or more disciplined in some abstract, generic sense. It's a direct structural consequence of the specific mutual ownership model itself, one that removed the underlying financial incentive present at nearly every other fund company to extract additional profit from fund shareholders beyond what was genuinely required to operate the funds competently. Bogle addresses a specific objection that inevitably arises whenever this philosophy is presented. The observation that some individual fund managers and some individual investors genuinely have beaten the market, sometimes for years or even decades at a stretch. He doesn't dispute this. With thousands of professional fund managers making investment decisions every single year, pure statistical chance alone guarantees that some meaningful number of them will post market-beating returns over almost any given stretch. In exactly the same way that if enough people around the world flip coins repeatedly, some meaningful number of them will flip an impressive, unlikely-looking streak of heads in a row purely through chance without any actual coin-flipping skill involved at all. He walks through this specific coin-flipping analogy in somewhat more mathematical detail, describing a hypothetical tournament involving many thousands of participants, each flipping a coin repeatedly, with each successive round eliminating everyone who flips tails. After enough rounds, a small handful of participants will have flipped an impressively long streak of consecutive heads purely through chance, and would likely attract considerable attention and admiration for their apparent skill if this were treated as a genuine competition of ability rather than pure random luck. Bogle argues that professional fund management examined honestly over sufficiently long stretches of time resembles this exact tournament considerably more closely than most participants and most outside observers are typically willing to acknowledge. He extends this analogy with one further sharpening observation. In the actual coin-flipping tournament, every participant faces identical odds and identical costs, meaning the eventual winners reflect pure, unadulterated luck alone. Professional fund management, by contrast, adds a further layer that makes the situation considerably worse for active management, since the funds themselves charge meaningfully higher fees than a simple index alternative. Meaning even a manager whose apparent skill genuinely reflects pure random luck still extracts a considerably higher cost from investors along the way than a low-cost index fund ever would, regardless of that manager's actual underlying skill or lack thereof. The tournament winners, in other words, get paid handsomely for a demonstrated streak of luck, at the direct expense of the investors who mistook that luck for genuine, repeatable skill. He closes this particular line of argument with a specific pointed observation worth remembering: that an ordinary investor genuinely has no reliable way of distinguishing in advance a manager whose recent success reflects genuine, durable skill from a manager whose recent success reflects nothing more than a lucky run through this same statistical tournament, and that this fundamental uncertainty, rather than any specific flaw in any individual manager's own character or effort, is precisely why Bogle considers the entire premise of confidently selecting future market-beating managers considerably shakier than the industry's own persuasive marketing would ever openly admit. Bogle adds a related practical observation about the fund management industry's own internal dynamics that reinforces this same underlying skepticism, describing the considerable turnover rate among individual fund managers themselves, even at otherwise well-regarded firms. A fund manager celebrated for strong performance over a given stretch frequently moves on to a new firm, retires, or is quietly replaced within a few years of that celebrated stretch, meaning an investor who selected a specific fund based on a specific manager's own track record often finds themselves a few years later actually invested in a fund now run by an entirely different person, with no particular reason to expect that new manager will replicate the original celebrated performance at all. He considers this turnover pattern yet another practical complication undermining the entire premise of selecting active funds based on a specific manager's demonstrated past skill, since that specific skill, even if genuinely real rather than pure luck, frequently isn't even the same person still actually managing the fund by the time an ordinary investor gets around to acting on that manager's celebrated track record. He connects this turnover pattern to a broader related concern about the fund industry's own internal incentive structure, noting that individual fund managers employed by firms whose own profits depend heavily on continuing to attract and retain investor assets sometimes face pressure to take on excessive risk in pursuit of the kind of standout headline-grabbing performance that attracts new investor money, precisely the kind of behavior that can produce spectacular short-term results followed by equally spectacular subsequent losses, a pattern considerably less compatible with an ordinary investor's genuine long-term financial security than the far steadier, more predictable trajectory a low-cost, broadly diversified index fund is specifically designed to deliver instead. The genuinely difficult challenge, Bogle argues, isn't finding examples of past outperformance after the fact. It's identifying in advance, before the fact, which specific manager will be among that small number of genuine outperformers over the coming years, a considerably harder problem than simply pointing to historical winners in hindsight, and one his own extensive research suggests even professional investment advisors, tasked specifically with this kind of manager selection, have proven remarkably unreliable at solving consistently over time. He offers a specific, sobering piece of research on this exact point, describing studies examining whether professional advisors, whose entire job consists of selecting promising actively managed funds on behalf of their clients, actually demonstrated any genuine measurable skill at this specific task, comparing the funds they recommended against funds selected essentially at random. The results in Bogle's telling showed remarkably little evidence that professional manager selection outperformed random selection over any sufficiently long period, a finding he considers powerfully consistent with his broader argument that genuine, reliable, advanced, identifiable skill at picking market-beating fund managers is considerably rarer than the entire advisory industry's own marketing would ever suggest. He extends this same skepticism to a related, frequently promoted alternative strategy. The idea of selecting funds based on sophisticated quantitative screening criteria, various statistical measures of past performance volatility and risk-adjusted returns, marketed as a more scientific, more rigorous approach to fund selection than simply chasing raw recent performance. Bogle examines this approach with the same skeptical rigor he applies throughout the rest of the book, walking through research, suggesting that even these more sophisticated screening methods have historically shown little genuine ability to reliably identify future outperformers in advance, tending instead to simply identify funds that performed well over whatever specific historical period happened to be used in constructing the screen, with little persistence into the subsequent period actually being predicted. He offers a specific, memorable way of thinking about why these more sophisticated screening methods so often fail to deliver on their promise, comparing the exercise to searching backward through a vast amount of historical data for whichever specific combination of statistical criteria happened to identify the actual historical winners, a process almost guaranteed to find some seemingly impressive pattern purely through sheer chance. Given enough different criteria and enough historical data to search through, that seemingly impressive pattern discovered after the fact by searching backward through data that already contains the answer rarely holds up nearly as well when applied forward prospectively to genuinely unknown future outcomes, precisely the actual test any investment strategy ultimately has to pass in order to be genuinely useful. He describes a specific memorable analogy for why these sophisticated-sounding screening methods so often fail to deliver on their promise, comparing them to a driver navigating almost entirely by looking in the rearview mirror, using an extraordinarily detailed, carefully calculated picture of exactly where the road has already been, while having comparatively little genuine insight into where the road is actually headed next. However statistically sophisticated the specific screening methodology happens to be, Bogle argues it remains fundamentally backward-looking in nature, and backward-looking analysis, however rigorously constructed, has consistently shown limited genuine power to reliably predict forward-looking fund performance, precisely the gap between sounding scientific and actually being predictive that he spent considerable effort exposing throughout the book. He offers a related practical warning about a specific category of fund particularly prone to this exact trap, so-called specialty or sector funds concentrated heavily in whatever specific industry happens to be generating the most excitement at any given moment. These funds, Bogle notes, tend to launch in large numbers precisely when a given sector has already been performing exceptionally well, attracting eager investors, chasing that recent excitement right around the point when that sector's own valuations have already become considerably less attractive, and its future returns considerably more likely to disappoint relative to the broader market average. He describes the specific, predictable business logic behind why fund companies tend to launch new sector-specific funds at precisely this unfortunate moment, pointing out that fund companies, like any other business, respond rationally to demand, and investor demand for a specific sector fund tends to peak precisely when that sector has already been performing impressively well and generating considerable media excitement exactly the moment least likely statistically to produce continued strong performance going forward. This creates a systematic structural pattern where new sector fund launches cluster disproportionately around sector peaks, setting up the very investors drawn in by that recent excitement for a considerably higher risk of subsequent disappointment than a simple broadly diversified total market fund would ever expose them to. He describes watching this exact pattern repeat itself across multiple different market cycles throughout his own career, a wave of new narrowly focused funds launching to capitalize on whatever specific industry happened to be dominating headlines that particular year, attracting enormous inflows of eager new investor money right near the top of that sector's temporary popularity, only to see both the sector itself and the newly launched funds tracking it underperform considerably over the following several years. Once the broader market's attention inevitably shifted elsewhere, he treats the fund industry's own pattern of launching new products, specifically timed to capture whatever recent excitement happens to be circulating, as further evidence supporting his broader thesis that the fund industry's own commercial incentives frequently run directly counter to what would actually serve ordinary investors' genuine long-term financial interests. He devotes attention to a memorable image worth carrying forward, describing the entire active management industry as, in effect, a battle between what he calls an immovable object and an irresistible force. Before turning to that specific battle, Bogle lays important groundwork by walking readers through where the stock market's own long-term returns actually come from in the first place, breaking total return down into two genuinely distinct components he calls investment return and speculative return. Investment return consists of the two fundamental drivers of genuine underlying business value: the dividend income a company pays out to shareholders, and the growth in a company's actual underlying earnings over time. Speculative return, by contrast, reflects something considerably less fundamental: the change in how much investors are willing to pay for each dollar of those earnings, a valuation multiple that can expand or contract considerably based purely on shifting investor sentiment, entirely independent of any actual change in a company's underlying business performance. Bogle argues that over any sufficiently long stretch of market history, investment return, the steady, genuine growth in dividends and earnings, accounts for the overwhelming majority of the stock market's total long-term gain, while speculative return, the expansion or contraction of valuation multiples, tends to average out closer to zero across long enough periods, even though it can swing dramatically and unpredictably over any shorter stretch of years. This distinction matters enormously, he argues, because it reveals that a great deal of short-term market volatility, the kind that tempts investors toward impulsive trading, reflects shifting speculative sentiment, rather than any genuine change in the underlying economic reality of corporate earnings and dividends, precisely the kind of noise a patient long-term index investor can afford to simply ignore entirely. He illustrates this distinction with reference to specific multi-decade stretches of actual market history, showing how dramatically speculative return, the expansion and contraction of market valuation multiples, has swung across different periods, sometimes contributing significantly to total returns over a given decade, sometimes subtracting significantly, while investment return, the steadier underlying growth of dividends and earnings, has remained considerably more consistent and predictable across nearly every comparable stretch examined. He treats this consistency of investment return, compared to the volatility of speculative return, as powerful evidence supporting patient long-term index investing, since an investor holding through an entire multi-decade period captures the steady, reliable investment return component in full, while largely riding out the more volatile, less predictable speculative swings that so often tempt shorter-term traders into costly, poorly timed decisions. He offers a related practical implication of this distinction worth carrying forward, cautioning against the common tendency to extrapolate a recent unusually strong or unusually weak stretch of total market returns indefinitely into the future, without properly accounting for how much of that recent performance was actually driven by the more volatile, mean-reverting speculative return component rather than the steadier, more durable investment return component. An investor who naively projects a recent decade's total return forward, without separating out how much of that return came from valuation multiple expansion, likely to eventually reverse itself, risks building unrealistic expectations that a properly disaggregated analysis distinguishing investment return from speculative return would have revealed as considerably less reliable a guide to genuinely expected future performance. The immovable object is the simple, unchangeable mathematics of the situation. The fact that active management as a whole cannot outperform the market as a whole once costs are properly accounted for. The irresistible force is the enormous, well-funded marketing and sales apparatus of the entire financial industry, an apparatus with every incentive to keep convincing ordinary investors that this year's hot fund manager or this year's exciting new investment strategy represents a genuine, reliable path toward beating that immovable mathematical reality. He describes the sheer scale of that marketing apparatus in some detail, pointing to the enormous sums the financial industry spends every year on advertising, sponsored research, and persuasive sales materials, all aimed at convincing ordinary investors that this particular fund, this particular strategy, this particular manager represents a genuine exception to the relentless arithmetic working against active management as a whole. He argues that this marketing spending isn't accidental or incidental. It's a direct rational response to the industry's own underlying economics, since active management charging considerably higher fees than passive index investing has a powerful financial incentive to keep convincing investors that those higher fees are genuinely worth paying, regardless of what the actual long-term data consistently shows. He offers a specific pointed observation about the particular language and imagery this marketing apparatus tends to favor, noting a consistent pattern of advertisement, emphasizing exciting, emotionally compelling narratives. A manager's impressive academic credential, a fund's recent standout performance, a compelling story about a specific investment thesis, rather than the considerably less exciting but far more decision-relevant information about the fund's actual expense ratio, its historical tax efficiency, or its long-term performance relative to an appropriate benchmark after all costs. Bogle considers this specific pattern of emphasis consistently favoring exciting narrative over decision-relevant arithmetic. One of the clearest tells that the entire marketing apparatus is designed to serve the industry's own financial interests rather than genuinely serving the ordinary investor's own best interest in making a fully informed decision. He suggests a simple, practical test any ordinary investor can apply whenever encountering this kind of persuasive marketing material, asking directly whether the advertisement in question actually discloses the fund's specific expense ratio clearly and prominently alongside its more exciting performance claims, or whether that considerably less flattering number is buried in fine print if it's mentioned at all. An advertisement genuinely confident in its own value proposition, he argued, would have no particular reason to hide its costs. One relying primarily on exciting narrative while downplaying or obscuring its actual costs is, in Bogle's assessment, telling you something important about which of the two, genuine value or persuasive marketing, actually underlies its appeal. He offers a related, practical piece of advice for any investor genuinely trying to see past this specific marketing pattern, suggesting a simple, deliberate exercise, reading a fund's promotional materials, specifically looking for what isn't emphasized, rather than simply absorbing what is. A promotional piece that spends considerable space celebrating a manager's credentials and recent performance, while burying its actual expense ratio in small print, somewhere near the bottom, or omitting any honest comparison against an appropriate low-cost benchmark entirely, is in Bogle's assessment, telling an attentive reader something quite revealing through that very omission, regardless of how genuinely impressive the featured, emphasized details happen to sound on their own. Bogle spent his entire career squarely on the side of the immovable object, insisting that no amount of persuasive marketing could ever actually change the underlying arithmetic, however convincingly that marketing might be presented. He describes this as, in some ways, the defining struggle of his entire professional life, standing against an entire industry's financial self-interest, armed with nothing more than the actual data and the simple, stubborn mathematics of costs and returns, waiting patiently for that mathematics to eventually persuade even skeptical observers, decade after decade, as the accumulating evidence grew simply too large and too consistent to keep dismissing. Bogle also addresses the specific related question of diversification, and how broadly an investor following his approach should actually spread their holding. He advocates for owning, effectively, the entire stock market, every publicly traded company, in proportion to its actual market size, rather than concentrating in a smaller subset of stocks an investor or advisor might believe represents a more attractive selection. This total market approach, he argues, offers genuine, measurable risk reduction compared to any more concentrated strategy, since the specific misfortune of any single company, or even any single industry, gets diluted across the entire remaining universe of publicly traded businesses, rather than being capable of devastating a smaller, more concentrated portfolio all on its own. He walks through the underlying statistical logic behind this risk reduction in accessible terms, explaining that a portfolio's overall volatility, its tendency to swing up and down in value, tends to shrink as the number of genuinely different, not perfectly correlated holdings within that portfolio grows larger up to a certain point. A portfolio holding the entire market, thousands of individual companies spanning every industry and sector, captures nearly all of the available diversification benefit. This principle offers considerably more than a portfolio concentrated in even a reasonably large handful of individually selected stocks. He offers a specific illustration worth sitting with directly, comparing an investor holding a total market index fund against an investor holding a seemingly well-diversified portfolio of 30 or 40 individually selected stocks, chosen with genuine care and research. The second investor, despite that genuine effort, still carries meaningfully more concentrated risk than the first, since even 30 or 40 carefully chosen companies represent only a small fraction of the thousands of publicly traded businesses available, leaving that investor genuinely exposed if even a handful of their specific selections happen to perform unexpectedly poorly in a way the first investor's far broader holding simply isn't exposed to in nearly the same degree. He extends this specific concern to a related, often overlooked form of concentration risk, sector concentration, describing investors who, without necessarily intending to end up with a disproportionate share of their overall portfolio concentrated in whichever industry happens to be most fashionable and exciting at any given moment, having selected individual stocks predominantly from that single hot sector without fully appreciating how concentrated their overall exposure had actually become, A total market index fund, by contrast, automatically maintains exposure to every sector in proportion to its actual overall size within the broader economy, preventing this kind of unintentional sector concentration from ever developing in the first place, regardless of which particular industry happens to be capturing the most headlines and investor enthusiasm during any given period. He offers a specific historical illustration of exactly this pattern playing out with real painful consequences. Describing investors who had become heavily concentrated in a single fashionable sector during a period of genuine excitement and rapid price appreciation, only to watch that same sector subsequently underperform badly for years once the broader market's enthusiasm inevitably cooled, dragging down their entire concentrated portfolio far more severely than a broadly diversified total market investor holding that same sector only in its ordinary proportionate share would ever have experienced. He treats this pattern, repeating itself across different fashionable sectors in different eras throughout his own long career, as further confirmation that genuine disciplined diversification protects investors against a specific, predictable kind of self-inflicted risk that a narrower, more excited approach to portfolio construction tends to systematically invite. He extends this diversification argument beyond individual stock selection risk to a related, often overlooked dimension: the risk of selecting the wrong specific fund manager or investment strategy altogether. An investor who selects a single actively managed fund, however carefully researched, is still making a concentrated bet on that specific manager's own skill and judgment continuing to hold up over the coming years. An investor holding a total market index fund makes no such bet at all, since the fund's performance depends purely on the aggregate performance of the entire market, rather than on any single individual's ongoing selection skill, removing an entire additional layer of risk that active fund investors, even careful ones, continue to carry. He describes this specific insight as in some ways the natural culmination of everything else discussed throughout the rest of the book, a final layer of diversification sitting on top of the more familiar layers, diversifying not just across individual stocks and industries, but across the very question of which investment approach or which specific manager to trust in the first place. An investor who owns the entire market has in effect diversified away not only stock-specific and industry-specific risk, but manager-specific risk as well, achieving a genuinely comprehensive form of protection against the many different specific ways an active selective investing approach could potentially go wrong. Bogle offers a specific, memorable phrase, capturing the entire philosophy behind why patience matters so enormously within this framework, describing time as an investor's friend and impulse as an investor's enemy. The single greatest advantage an ordinary, patient investor holds over the entire trading apparatus of professional Wall Street isn't superior stock-picking skill. It's the simple willingness to actually hold a broadly diversified position for years or decades, allowing the market's own long-term historical tendency toward growth to compound quietly in the background without constantly disrupting that compounding through impulsive trading driven by short-term fear or excitement. He walks through the specific historical data supporting this patience, directly pointing to the stock market's own long-term track record across an entire century or more of recorded history, a record showing that despite countless individual recessions, crashes, wars, and periods of genuine economic turmoil along the way, the broader market's overall trajectory across any sufficiently long multi-decade stretch has consistently trended upward, rewarding investors who simply stayed invested throughout that entire period. Rather than attempting to jump in and out based on short-term predictions about which specific years would be strong, and which would be weak. Bogle describes this century-long trajectory using a specific memorable phrase, calling it the majestic long-term returns generated by American business, a phrase capturing his genuine, almost reverential respect for the stock market's underlying long-term productive power. Entirely distinct from his considerable skepticism toward the shorter-term trading and speculation that so often obscures that same underlying steadier reality. He argues that this distinction between respecting the market's genuine long-term wealth-creating power while remaining deeply skeptical of short-term trading and speculation sits at the very heart of his entire philosophy, and explains why he considers himself, despite his famous skepticism toward active management, a genuine, enthusiastic believer in the stock market itself as a wealth-building tool for ordinary patient investors. He offers a specific illustration of just how powerful this long-term compounding has proven across actual historical periods, describing what a relatively modest initial investment left entirely untouched and allowed to compound at the market's own long-term historical average return would have grown into across a full multi-decade working career, a figure that in Bogle's own retelling consistently surprised even financially sophisticated audiences when they actually worked through the specific arithmetic for themselves, precisely the kind of eye-opening realization he hoped every reader of the book would eventually experience for themselves. He describes watching, across his entire career, countless ordinary investors undermine their own long-term returns through exactly this kind of impulsive behavior, selling in a panic during a market downturn, precisely when a patient, disciplined investor following the simple buy-and-hold approach would have been better served waiting calmly for the market's historical tendency toward eventual recovery to reassert itself and buying enthusiastically during a period of market euphoria, precisely when valuations tend to be least attractive and future returns tend to be weakest. Bogle argues that a great deal of active management's underperformance isn't purely a matter of fees and costs alone. It reflects a broader pattern of impulsive, emotionally driven decision-making that a genuinely disciplined, low-cost buy-and-hold index strategy is specifically designed to protect an ordinary investor against. He describes a specific, memorable account from his own career, illustrating this exact pattern, recalling conversations with investors during a period of severe market decline, who described feeling an overwhelming, almost physical urge to sell everything, immediately convinced the decline would only continue getting worse, despite having no genuine specific evidence supporting that particular prediction beyond the raw emotional discomfort of watching their own account balance shrink. Bogle describes counseling patients during exactly these moments, pointing back to the market's own long, consistent historical pattern of eventual recovery following even its most severe declines, a pattern that, however emotionally difficult to trust in the anxious moment itself, had proven remarkably reliable across every comparable period of market history he'd personally studied. He offers a related, practical piece of advice for actually building this kind of patience into an ordinary investor's own behavior, rather than relying purely on willpower alone to resist the temptation toward impulsive trading. Setting up automatic regular contributions to a broad index fund, continuing consistently regardless of what the market happens to be doing in any given month, removes a great deal of the emotional decision-making that so often derails less disciplined investors, since the investment decision itself has already been made once calmly in advance, rather than requiring a fresh, potentially emotionally charged decision every single time new money becomes available to invest. It's worth pausing here on a fair, honest set of objections occasionally raised against the entire indexing philosophy, worth acknowledging directly rather than glossing over. Critics have pointed out that as index investing has grown to represent an increasingly large share of the overall market, some genuine questions arise about what happens to the underlying process of price discovery, the ongoing work of analysts and active traders that helps keep individual stock prices reasonably aligned with their underlying business fundamentals in the first place. If an ever-shrinking share of overall trading activity continues to be conducted by investors actually researching individual companies rather than simply buying the entire market indiscriminately, Bogle addresses this concern directly in later editions of the book, acknowledging it as a genuinely legitimate, worthwhile question, while arguing that even a relatively modest remaining share of active price-discovering trading activity conducted by professional traders and analysts still competing actively against each other appears sufficient to keep the broader market's prices reasonably efficient based on the evidence available at the time of his own writing. He's careful to frame this as an ongoing, evolving question worth continued attention as index investing's overall market share continues growing, rather than dismissing the concern entirely, a rare moment of genuine, explicit humility amid an otherwise supremely confident book. He offers a related, somewhat reassuring observation on this exact point, noting that the active traders who remain in the market precisely because index investors are no longer competing directly against them for the same trading opportunities, actually face somewhat less overall competition for whatever genuine mispricing does still occasionally occur, potentially preserving a reasonable incentive for at least some meaningful level of continued active trading and price discovery, even as an ever larger share of overall assets shifts toward passive indexed strategies. He treats this as a plausible, if not fully proven, mechanism by which the two approaches, active and passive, might continue coexisting in a genuinely stable equilibrium over the long run, rather than passive investing eventually growing so dominant that price discovery breaks down entirely. He acknowledges with characteristic candor that this remains an area of genuine ongoing debate among serious researchers, one he doesn't claim to have definitively settled, unlike the considerably more mathematically certain cost matters hypothesis underlying the rest of his broader argument. He encourages readers to keep watching this specific question as index investing's market share continues to evolve in the years following the book's own publication, treating intellectual honesty about the limits of his own certainty as itself an important part of the disciplined, evidence-based thinking he spent his entire career encouraging in others. He offers a related, somewhat reassuring observation on this exact point, noting that even as index funds have grown to represent a larger and larger share of total assets under management, they still represent a considerably smaller share of actual day-to-day trading activity, since index funds, by their patient, low-turnover nature, trade their underlying holdings far less frequently than active traders do. This means the share of daily trading volume actually driving short-term price discovery has historically remained considerably more dominated by active participants than the headline asset under management figures might otherwise suggest. A nuance Bogle considers important context for anyone worried that growing index fund popularity might somehow undermine the market's own underlying pricing mechanism. He addresses a second, related criticism as well, the concern that broad index funds, by their very nature, invest indiscriminately in every company within a given index, including companies an active, discerning investor might have specifically wanted to avoid for various fundamental reasons. Bogle's response leans back on the same core arithmetic, underlying his entire argument that the costs saved by avoiding active management's fees and taxes taken in aggregate across the entire investing population have historically outweighed whatever benefit active managers as a group have actually managed to extract through this kind of discerning selective avoidance, even accounting for the genuine occasional value some individual active decisions might provide. If you're wondering what any of this actually looks like translated into something you could genuinely start this week, Bogle's own philosophy scales down to something considerably simpler than most of the financial industry would ever want you to believe. Look up the specific expense ratio charged by every fund you currently hold, in every retirement or investment account you have access to, and compare each one directly against a broadly diversified low-cost index fund tracking a similar segment of the market. Calculate honestly what that fee difference might genuinely cost you, compounded across however many years or decades remain in your own investing timeline, and consider seriously whether the specific active fund you currently hold has actually demonstrated a genuine, sustained track record of outperforming its relevant benchmark after fees over a sufficiently long period, rather than simply trusting a fund's marketing materials or a single strong recent year at face value. While you're at it, take a moment to check whether any employer-sponsored retirement account you participate in actually offers a genuinely low-cost index option among its available choices, since not every plan does. And if yours currently doesn't, Bogle would likely encourage raising that specific gap directly with whoever administers your plan, a simple concrete request that multiplied across enough employees making the same reasonable ask has historically been one of the more effective ways ordinary people have actually succeeded in expanding access to genuinely low-cost investment options within their own workplace retirement plans. He offers one further specific piece of guidance worth carrying into this weekly exercise, encouraging investors to check not just a fund's headline expense ratio, but also its historical tax efficiency, comparing how much of its total return over recent years has actually been distributed to shareholders as taxable capital gains versus how much has simply compounded quietly untaxed within the fund itself. A fund with a seemingly reasonable expense ratio, but a genuinely poor record of tax efficiency, might still impose a considerably larger total drag on an investor's actual after-tax return than the headline expense ratio alone would suggest, precisely the kind of hidden, easily overlooked cost. This entire framework is specifically designed to help an ordinary investor finally notice and account for properly. You likely won't need to make dramatic, sweeping changes to act on what you've learned here. Bogle's entire philosophy was built specifically around simplicity, not complexity. A single evening spent comparing your current fund costs against a low-cost index alternative, and shifting even a portion of your future contributions toward that lower-cost option, represents exactly the kind of small, disciplined action that, compounded patiently over years, can meaningfully change your own eventual financial outcome without requiring any special expertise, any exciting new strategy, or any confident prediction about which stock or which manager will happen to outperform next year. There's a specific, quiet dignity Bogle found in this entire approach that's worth carrying forward beyond the pure mathematics of it all. He often described genuine satisfaction throughout his later years, not in any personal fortune he'd accumulated, but in the countless ordinary investors, people he'd never personally met, who had written to him over the decades, describing how a simple, low-cost index fund had allowed them to retire comfortably, send a child to college, or simply sleep more easily at night, freed from the constant anxiety of chasing whichever hot stock or hot manager happened to be dominating headlines that particular year. He considered this quiet, widespread, largely invisible impact Multiplied across millions of ordinary households, he'd never directly encounter the single most meaningful measure of his entire career's worth, considerably more meaningful to him than any specific financial metric or any individual accolade ever could be. He describes reading a great many of these letters personally over the years and treating that ongoing correspondence as a genuine, sustaining source of motivation throughout the decades of continued advocacy that followed his original difficult launch. He recounts specific letters from investors who had never previously considered themselves financially sophisticated, describing how the simplicity of his core message owned the whole market. Keep costs low, stay patient had made genuine, disciplined investing feel accessible to them for the first time in their lives, precisely the democratizing outcome he'd hoped his entire career's work might eventually achieve, reaching considerably beyond the relatively narrow circle of professional investors and financial insiders who had originally dominated the conversation before his own persistent advocacy helped shift it. He describes this democratizing impact as, in many ways, the true measure of everything his career had actually accomplished, considerably more meaningful to him than the sheer scale of assets his company eventually came to manage, making genuinely sound, disciplined investing accessible to an ordinary person without any specialized financial training, armed with nothing more than a willingness to keep costs low and stay patient represented in his own final assessment, the fulfillment of exactly what he'd set out to accomplish decades earlier. Back when a nearly failed first index fund had struggled simply to attract enough interest to survive its own difficult opening months. The next time you encounter an advertisement promising a fund manager's exceptional recent track record or a friend's confident recommendation about the next great stock pick, you might find yourself asking a considerably simpler question than usual, not how much could this specific pick make me, but instead, once every fee, every commission, and every unnecessary tax along the way has actually been subtracted, how much of the market's own return am I genuinely likely to keep for myself compared to simply owning the entire haystack from the very beginning? Because the relentless rules of humble arithmetic, the ones John Bogle spent an entire career insisting ordinary people deserved to actually understand clearly, were never really about predicting which stock or which manager might win next year. They were about recognizing that the surest, most reliable way to actually capture your fair share of the stock market's own long-term growth was never to search endlessly for the exception. It was simply to own the whole thing, patiently, and let the relentless arithmetic finally work in your favor instead of against it. Somewhere between a horse racetrack's croupier's take and the largest index fund provider in the entire world sits a genuinely simple idea. 1. John Bogle spent an entire career and an entire company trying to convince ordinary people to trust that the surest path to genuine financial security was never found in chasing the exception. It was found in patiently, humbly owning the whole thing, and letting the relentless, unglamorous arithmetic of low costs and long-term compounding quietly do the rest. And maybe that's the most powerful lesson John Bogle left behind. Building wealth doesn't have to be complicated. You don't have to predict the next crash. You don't have to discover the next great stock. And you don't have to beat Wall Street. Sometimes the smartest strategy is simply to own the market, keep your costs low, and give time the chance to do the heavy lifting. If you want to continue building your financial knowledge, click the next Money Files audiobook on your screen and subscribe to Money Files audiobooks for more powerful lessons from the world's greatest books on investing, money, and wealth. Remember Bogle's simple idea: don't look for the needle, buy the haystack. I'll see you in the next audiobook.